Perfect. Welcome back to, I think, the fourth session on financial statement. We'll need one more actually. I don't know whether we'll need the sixth one or not. We'll try and see if we can finish it this weekend, so that I think you can start a new topic next weekend. If we can't, I think we'll take it over to the next Saturday at best. I don't think we'll stretch beyond next Saturday on financial statement. Perfect. So let's get started now. There are two broader topics lined up for today. One is long-term liabilities and equity, and the other is analysis of income tax. The more important one for the day is obviously long-term liabilities and equity as a reading, right? Because I think more questions are oriented towards long-term liabilities and equity than income tax. Always remember, this is a program which is not an income tax driven program, right? As I've said previously, this is not about income tax. This is about financial statement analysis. So this is about a chartered financial analyst program, right? So income tax is just incidental out here. It does cover a couple of concepts on deferred tax, effective tax rate, but not critical from an exam perspective. So if you're running short on time, income tax is your least priority. If you can read it, obviously, but necessary, you should read it because at the end of the day, it's part of the financial statement, right? But yes, if you want to prioritize, I would say income tax is your least priority from level one perspective. There may be a couple of questions on the exam, and if you're running short of time, I think you'll just manage those two questions. Let's start with long-term liabilities then and equity. Now, the long-term liabilities and equity starts with leases, right? The upfront and the most important topic is lease, which are nowadays known as right of use assets and right of use liabilities, right? So nowadays, what leases are called is right of use assets and right of use liabilities, right? So on the balance sheets, what you're going to call them is an ROU. You have a right of using an asset, and therefore you also have a liability associated with it. Now, agreement under which the owner allows use of his assets in lieu of some consideration is called as a lease. It's typical a rental arrangement. We can put it like a rental arrangement. The only difference is leases are usually long term, and typical rental agreements are short run rental agreements. The owner and the user, there are two entities to this agreement. The owner is the lessor and the user is the lessee. Owner receives the payment while the lessee makes the payment, and the lease installment are paid for the lease period. You will typically have a lease period, let's say a 2-year lease or a 3-year lease or a 20-year lease or a 99-year lease, right? Leases could go fairly long as well. Now, the leases are classified under two categories: operating lease and finance lease. Operating lease is typical rental agreements, more of like a rental agreement. You take an asset on rent, no capital ownership involved for the lessee. You don't own the asset, you're just taking the asset on rent. While finance lease is more of the nature of purchase of an asset with debt, right? So in finance lease, you technically become the owner of the asset. The capital interest is involved for the lessee. This is like buying an asset, right? Finance lease is similar to buying an asset. You take a loan and buy an asset. It's like buying a brand new car, right? You take a loan and you buy a car, which effectively is very similar to taking a car on a finance lease. And Mercedes may offer you a brand new Mercedes on finance lease. Technically, they are selling a car. They're also providing a loan on the car. So it's more or less ownership. Finance lease means you're owning the asset. Now, in this, how do we classify leases? For a lessee, we are talking about from a lessee's perspective. And in the exam, be very clear whose perspective is being talked about. Is it lessee or lessor, right? From whose perspective are we, talking about these payments? So from a lessee perspective, finance lease under IFRS and US GAAP versus operating lease. The conditions, the present value of lease payments will be recorded on the balance sheet as an ROU and a lease liability. So an asset and liability both will be recorded. And then this will be amortized over the contract of the lease in a straight line basis. Fixed payments, interest and principal reductions. Now, let me run a quick math for you. Let me see if there is a math somewhere around this. So we can use the same numbers and yeah, perfect. So we have a math. Let's run the numbers and then we'll come back to this, theoretical description that will make a lot easy for you. So let me just quickly open an Excel sheet to run the numbers for you. And I think then the English will make a lot more sense in terms of what we are trying to speak. And especially in finance lease, this is critical. In operating lease, there is not much. In operating lease, it's very similar to, in IFRS, same treatment as finance lease. While in US GAAP, different treatment, you simply just amortize and pay interest, right? So operating lease are simpler in terms of accounting. Finance lease will need an additional aspect. Now the point is, now this difference between finance and operating lease has been eliminated with new accounting frameworks. Now operating leases are very similar to finance lease. You will have to treat them very similar to finance lease. Only the difference is in US GAAP, amortization is payment less interest and reduces both liability and balance sheet assets. So let's do a quick math. It's a very easy math. A lot of people leave the mathematics because they believe it's confusing or it's difficult, but I think it's extremely easy. And once you understand the math, a lot of the lease related topics are automatically, you'll remember them. You don't have to memorize the concepts. So let's just put an Excel sheet on your screens. Perfect. And let's now model a lease for you. So what we are going to do, we are going to just take the same example, right? Proton Enterprises, a hypothetical manufacturer based in Germany, is offered the following terms to lease a machine: 5-year lease with implied interest rate of 10%, annual lease payments 100,000 euros, and straight line 5-year. Okay, and now we need to see how do we report them. So let's put these things on our Excel sheet. Step 1, we have annual lease payments, which has been given to us. And these payments are effectively 100,000 euros. Okay, and always remember these payments will be made over a period of 5 years, right? So that is your 100,000 payments. The interest rate, sorry, is 10%. And that is always a per annum rate. And the tenure of the lease is 5 years. Now, what do we need to do? What would be the impact of this lease on Proton's balance sheet? That is what we are trying to assess. And we want to report this under IFRS. Along with this, we are also trying to assess what would be the impact on income statement and cash flow. So let's now try and model all of these things. Let's try and now model all of these things from our perspective of balance sheet. Step 1, calculate. And I think this is something that you should remember. Calculate the present value of all lease payments, right? So you can simply say, I'm going to make some lease payments like this. Use a present value function on your calculators if you want. I'm just explaining it in a much lengthier format for the ease of getting this through. And let's say these are my payments for the next 5 years. I'm going to make 5-year payments in this fashion. So what are my present value of the payments? My present value of the payment will be this divided by 1 plus R 10% raised to the power 1, 2, 3, 4, 5, right? So we are doing 5-year payments. So 1, 2, 3, 4, and 5. I have discounted all my payments to present value. And the total for me is equal to sum of these 5 payments. Any concerns? Till here, anything that you missed out? So we have just calculated present value of all the lease payments for over the 5 years. And this is your total present value, which is 379,000 pounds or euros actually. Now, what do we do with this? This 379,000 that you get will be recorded on your balance sheet. That is your step 2. Step 2, record this value on the balance sheet as liability and also as asset. Now, please understand there is no way to calculate asset value. What we can only calculate is liability. This 379,000 is my liability. I have to make this payment, right, over the next 5 years. But how do I calculate the asset? There is no way to calculate an asset. We will simply assume this is the liability and the liability is equal to the asset. Okay. So there is no other way for you to assess the asset number. This is the asset. This is the same liability. Now, so on the liability side, we will say opening value of liability. Okay. And that is basically before I start accounting year zero. My opening value of liability. Then from that, these payments, interest expense. I'm just making a table for you. Principal amortization and closing value. So this is how my liability table will look. So my value is at present 379,000. That is my year zero value that I have recorded. And please follow the table very carefully. Now year one opening value is equal to year zero closing value. Problem sorted till here. Now what are my lease payments? My lease payments I know are 100,000 for the next 5 years. 100, 100, 100, 100, 100. This is my lease payment for the next 5 years. Now, what is my interest expense? My interest expense is my opening value into the rate. So opening value multiplied by my interest rate of 10%. It's technically a loan. So what you're doing on a loan, you're treating it like a loan. On a loan of 379,000, you are paying a 10% interest. That is your interest expense. So this becomes my interest expense, 37,908 for year one. Principal amortization is difference between the two, right? Always remember, this is like an EMI. Okay. And from the EMI, you subtract interest expense. And every EMI has two components, principal component and interest component in a loan. So from the EMI, if I subtract interest, what I get is my principal. So my principal amortization will be 100,000 euros minus 37,908. And this principal amortization gets subtracted from your opening value to give you the closing value. So that is your first year calculations. This principal amortization will get subtracted from your opening value. So this is open minus principal. This is nothing but EMI minus interest. This we have already talked about. Opening value multiplied by interest rate. So your liability reduces after 1 year to 316,987. Any concerns? Anything that bothers you on the first set of calculations, first column? Because if you got the first column, you've got the table. The table is done. Perfect. Okay. Now, next year, 316 becomes your opening number. Lease payments don't change. Interest expense will be 10% of the opening value. Principal amortization will be 68,000. Difference between EMI and interest. And your value of liability will further reduce to 248. If we keep doing this for the next 5 years, the liability value goes to 0. We are saying we started with a liability of 379. But now because I have made 5 years of payments, the value of my liability has gradually declined to 0, in which I have amortized my liability entirely. Right? This is as good as a loan amortization. You're repaying the loan gradually by paying EMIs, and your loan is getting paid off by X amount every year. So this is your liability treatment of the lease. Now, what happens on the asset side? If you remember, we said you will have to do a very similar thing on the asset side. On the asset side of the balance sheet, this is the liability side of the balance sheet, right? Always remember, this is the liability side of the balance sheet. And we said, do a very similar thing on the asset side of the balance sheet. Create the same asset. There is no other way to create an asset. Create the same asset. That should be the opening value of the asset. And here you are going to do amortization or depreciation, whatever you want to call it. Given this is lease, I would rather use the word amortization, which will be value divided by life or value divided by the tenure. Right? So your amortization will be the number divided by 5 because it's a 5-year lease. Right? So straight line basis method, right? Well, you will use a straight line method. And in straight line method of amortization, you will simply take the value of the asset and divide it by 5. So now your value of the asset goes from 379 to 303. Next year, 303 is your opening value. In straight line amortization, the amortization remains same every year. So you just keep doing this. And in 5 years, your asset also goes to 0. Effectively, the complete lease has been now settled. In 5 years, your asset values also go to 0 and your liability values also go to 0. First, you should be able to do this table and then let's talk about the English around the table. But anything on the table, give it a look. If you have questions, please ask. All good? Okay, perfect. Now let's look at the slide to help you understand this. Exactly same concept. Balance sheet treatment, calculate present value. That present value becomes asset. That present value also becomes liability. Right? 379,079. And what we have is 379,079. Next, the asset will get amortized 379 by 5 year, 75,816 every year, which means the value of the asset will keep reducing every year by 75,816 and your asset amortization will be done. So that is what we did. We did 75,816 and we amortized the asset completely. Next, how do you treat it from a liability perspective? You start with 379, pay an interest of 10%, payment 100,000. The difference of the two is principal, which this table is missing. They've directly subtracted the principal here. Their closing liability is 316,987. This 316,987 becomes your opening liability, goes here, comes here, goes here, and in 5 years, you will see your liability is 0. That is exactly what we have been doing, right? So for us also, our amortization is 75,816 and our liability is also going to 0 and asset is also going to 0. So for us, it's very similar to what we are doing here. For asset, amortize it over 5 years, 75,816 over the next 5 years, and your value of the asset will go to 0. For liability, very similar. Opening liability, interest, payment, and then there will be a principal in between. You will amortize and show a closing liability. What we did here as 62,092, 68,301, 75, these are the numbers you see here. So the liability accounting is very simple. When you have a finance lease, first calculate present value of the liability, record that as an asset, record that as a liability. There is no other way to do an asset liability calculation. The same present value becomes asset and liability. To asset, you do an amortization using straight line method, right? Straight line method of amortization, which is nothing but the cost of the asset divided by the life of the asset. And for liability, you do an amortization like this. Now in this, this interest expense that you see here goes to your cash flow from operation. That goes to your cash flow from operation. And the principal repayment that we calculated goes to your cash flow from financing. So from an accounting perspective, this is how your balance sheet will look. What is going to go on your income statement? So on the income statement, we are going to record one interest expense. This is part of income statement. This is going to impact your income statement. We are also going to record what is called as an amortization expense. These both the things will be recorded on your income statement. Perfect. So the impact is very easy to understand and assess. And now if you read the English, it will make a lot more sense. For finance lease, calculate present value of these payments. Call it right of use asset, call it liability, both. Then you amortize the asset over straight line for 5 years. Fixed payments, interest goes to cash flow from operation and principal goes to cash flow from financing. The only thing is, in operating lease, your lease expense is equal to the payment, and interest plus amortization is not reported separately in income statement. You simply report your lease expense. You don't report interest and amortization separately like we just did for finance lease. Take an example of operating lease. Same example using operating lease. But before that, any questions on the table? Anything that you didn't understand on the table? All good? Okay. Take the same example under US GAAP. You will have a same value, 379079, asset and liability. For your amortization, same number. For your interest, same numbers. Total is 5 lakh. Now the only difference is in this, you are going to report only operating lease expense, right? You are not going to show interest and amortization separately. You are just going to show operating lease expense, right? So in operating lease, there is no difference largely, right? In operating lease, it is more or less a rental agreement, right? In this case, you are doing interest expense plus amortization expense. How much is your total? Your total is this. Okay, and aggregate number is 500,000, which was our value of the lease, total value of the lease. But under this is income statement under finance lease. Now, if you have to do income statement under operating lease, right, let's say you don't have to do a finance lease. You will simply show lease expense. And your lease expense, you know, in operating lease will be only this. It's a rental arrangement. It's as simple as a rental arrangement. So it doesn't matter. You do it like an operating lease, you do it like a finance lease, your total expense will remain the same. We just don't show the separate bifurcation of interest and amortization in operating lease. In operating lease, we simply show lease expense every year. Yes, what is this going to do? This is going to change your profit numbers, your cash flow numbers, because, you know, for example, in finance lease, you will have higher expenses initially. In operating lease, you will have lower expenses initially, which means in finance lease, profit after tax will be lower. In this, profit after tax will be higher initially for the first 3 years. But after that, you will have a different number. These numbers will be lower, while these numbers will be higher. So PAT here would be higher later years, PAT here would be lower later years. Right? So these things will keep changing. And that is exactly what we need to remember. That earnings in early years, finance lease will be lower, as I said. And in this, higher. But in later years, higher and lower. So once again, you cannot remember this. You will have to derive this, or you will have to just do the quick math and understand what we are trying to answer as a question, right? There's no way to memorize these tables. It's always advisable, therefore, derive the tables. Now, how does the lessor do an accounting? Right. So what will be the lessor do? This is all from a lessee perspective. Whatever we did is all from a lessee perspective. Lessee calculates a liability, lessee records an asset, and this is how all the lessee will work. What will happen on the lessor side of the balance sheet? So on the lessor, if it is a finance lease, the lessor will record the present value as a receivable asset. And the leased asset will be de-recognized, which means it will be removed from the balance sheet of the lessor. The difference in present value of lease receipts and the carrying value of the asset is the income statement gain or loss. So if your present value is 379,079, but your asset value was only 3 lakhs, then that $79,079 is your gain. This is your carrying value. That becomes a gain. Effective interest reported as revenue if leasing asset is a primary business activity. So any interest that you receive is your revenue. While an operating lease treated as a rental agreement, assets remain in the lessor's balance sheet and is depreciated. Not treated as financing activity, lease revenue recognized on a straight line basis. So let's look at from a lessor perspective, right? And if you want, you can do the same lease from a lessor perspective. So on a lessor's perspective, first, what data has been given to us? These are the same numbers, nothing changes. We have been given a carrying value of the asset. And the asset before the lease was worth 350,000. Depreciation 0, depreciation method 5 years, straight line. And now you need to do the treatment. So present value of lease receipts we know will be 379,000, which effectively means if I subtract the carrying value, that is the gain. That is the amount of money I already gained because I was able to lease out an asset at a higher value. That is my gain of 29,000 euros. Now, let's look at it from a lesser perspective. The lesser is going to do exactly the same. For the lesser, the table is not going to change. Remember this. The only thing that we are going to change from a lesser perspective, we'll just copy the entire table. We will paste the table here. The lessor is going to record an asset. Right? This is lesser accounting. Always remember this is lessor's accounting treatment. He's not going to call it a liability, he's going to call it an asset. And this will be opening value of receivable and closing value of receivable. Because the lessor is going to receive this money, right? So for him, that is a receivable. It will be lease payments received. This will be income, not expense. But the accounting will remain exactly the same. So nothing changes on the accounting, and therefore, if you see the table remains exactly the same for the lessor. The only thing is the balance sheet now calls it a receivable asset because they are going to receive this money. It's not a liability, it's an asset. All the money that they get will be cash flow from operation, and interest income again will be recorded in the profit and loss, interest revenue. 37,908, 31,699, 24, 17, and 9. 37, 31, 24, 17, and 9. So the accounting remains exactly the same on the lesser side. The lessor obviously has to depreciate the asset also if it's an operating lease. So in an operating lease, 350 is the carrying value divided by 5, 70,000 every year. The asset also goes to 0. Income statement impact. See, how much was the lessor making here? Let's look at this. Okay, so let's just quickly look at this. Sorry, perfect. Now, let's see lesser income in finance lease. So if it's a finance lease, the lessor gets interest income. The total income that the lessor has is 120,000. Okay, that is what they get as income, right? Because they have the asset. They have given the asset out on lease. Technically, they have sold the asset. Because they've sold the asset, they make this as an income. Along with this, the income that the lessor makes here, the lessor also makes gain on sale of asset. Right? What was the gain? The carrying value was 350. So the lessor also made 29,000 of gain. That was also the gain for him. So his total profit or total money that he made was 150,000 by leasing out. Finance lease. Now, lesser income in operating lease. If the lessor says, I want to do an operating lease, the lessor is going to get lease payments. Lessor will say, every year I'm going to get lease payments of 100,000. But because this is operating lease, asset will be my asset. I'm not going to sell the asset. So I will have to depreciate. And the depreciation we said will be 350 divided by 5. 70,000 will be depreciation every year. So my net profit in this case will be this minus this 30,000 per year. Right? My net profit here as a lessor in finance lease was 150. And even under operating lease, my net profit remains 150. So like we talked about lessee, that it does not matter for the lessee. The lessee can structure it as a finance lease, right? The lessee is going to make the same amount of expenses. Operating lease, the same amount of expense, 500,000. Similarly, lessor treated like a finance lease, treated like a operating lease, their profit would be the same. And this means neither the lessor nor the lessee has any advantage or disadvantage structuring it as a finance versus operating lease mathematically. Mathematically, there is no advantage or disadvantage. The only thing that can motivate the structuring is whether you want to show higher or lower profits occasionally. Do you want to put it on the balance sheet or keep it off balance sheet? Right. So for a lesser, finance lease gain plus interest revenue, operating lease revenue minus depreciation. In either case, their total is what we said 150,000 euros. Balance sheet and cash flow comparisons. On the balance sheet, the lease receivable gradually goes declining, and even your assets gradually decline under an operating lease or under a finance lease. And in cash flow from operation, you are going to show what you receive as income, 100,000. So then, what drives the decision of an operating versus finance lease? Certain incentives around tax or recognition of asset or liability on the balance sheet, right? So first, why would you like to do a lease rather than buying the asset? The asset is if it is required for a shorter period of time as compared to its useful life, then you would like to lease the asset rather than buying it. Classical example, if you need, let's say, an oil exploration machine, right? You need an oil rig. An oil rig will explore, do the exploration activity for you. So you know that the exploration is only going to continue for the next 2-3 months. So for the 3-month activity, you don't want to buy an oil rig. You want to just take it on lease. Because if you take it on lease, your 3 months of job is done. And after that 3 months of job is done, you can give the asset back to the lessor. You don't want to own the asset. You don't want the risk of keeping the asset with yourself. So to avoid the risk and difficulties associated with reselling the asset after use. And third, the asset is of general nature, not specialized. For example, office space, vehicle, or etc. You want to just lease it rather than buying the asset or keeping it with you because it's normal assets. There's nothing specialized about the asset to buy and keep it. Then what is the incentive for structuring the lease as an operating lease? If the lessor has a higher tax bracket, which means they pay higher taxes, treating the lease as an operating lease can result in tax advantages in initial years and hence less cash taxes due to depreciation expenses, right? Higher expenses, lower profits, and lower profits will be lower taxes largely. So if you want to save taxes, you may want to treat it in a different format. For the lessee, an operating lease avoids recognition of an asset and a liability on the balance sheet. You don't recognize. You simply call it a rental arrangement. You take it on an as good as a rent, and after taking it on rent, you just give it back. There is no asset, no liability on the balance sheet. All your ratios related to asset and liabilities look good. Now, this was the erstwhile scenario. This was something which was done long back. Over the last 4 or 5 years, lease accounting has changed. And now your finance and operating leases are more or less treated similarly. Because the regulators and the accounting bodies did understand this problem. They did realize that companies were using operating lease as an off-balance sheet activity. Right. So although the company had a lot of obligations to meet, company has taken assets on lease and company has to make those payments. The company was not showing it. And if the company was not showing it on the balance sheet, that was understating the liabilities. So the regulators were cognizant about this fact and they changed the way lease accounting was done. So now the changes to these lease accounting have kicked into, and now the treatment is very similar. Okay, so now you don't have a lot of difference in lease accounting. We have made changes on both US GAAP and both IFRS. There is a accounting standard which is 842. I think ASC 842, and in IFRS we have IFRS 16, which have now brought operating lease to the balance sheet. Right. So if your operating lease is greater than 12 months, you have to record it on the balance sheet. So this will increase your liability on the balance sheet, and this will also change a lot of elements like EBITDA. You will have interest expenses now. So your lot of ratios are going to change. Perfect. So that is, I think, that we know that we should be aware about leases. Anything on leases that you didn't understand, you want me to explain again? From a mathematical standpoint, anything that bothers you? Okay, perfect. Let's go back then.
So,
Let's then, yep. I'm
so
sorry.
in the exam, will we have access to Excel? Like, if we have to make a table, or do we have to make it manually?
You will have to do it manually. You won't have Excel based tool available.
So So you'll
Right?
have to do this manually, right?
Yes. So they are not going to obviously ask you the table. What you can do, don't make a 5-year table if you ever have to make. You can make a 2-year table. Simple. It should still get you the same numbers, same answers, right? So if this is a 2-year table, and let's say I don't want to do a 5-year table, that would be quick and fast, right? Rather than doing all this for the 5 years, you can just make it a 2-year table. Also in 2 years, you will notice your asset goes to zero, your liability goes to zero, everything goes to zero in 2 year also. So it's a quick fix. You will be able to prove a lot of relationships rather than, doing it manually. So just be very careful about those aspects. I think somewhere this should be a 2-year number. And now I'll have to work around my asset numbers. I didn't automate actually the numbers here. So, but you can do it for 2 years. And in general, in the exam, they will ask you concepts like if there is a lease, what should be the value of the asset? So you will say, present value of liabilities is equal to asset. Largely, there is no other way to calculate asset value. You calculate the liability value and you equate it to the asset value. What happens to liability? Liability get amortized. There will be interest expense. What happens to asset? Asset will be depreciated, right? And you will have to just maybe answer a lot of theoretical questions to begin with. But yes, if math comes up, I think these are easy to solve mathematics. I think you should be able to handle it with relative ease. That is the end point of doing a lot of these math here.
Okay.
Perfect. Then the next liability that we typically have on our balance sheet is employee compensation. Now, employee compensation is also a liability that we need to work with. When we say employee compensation is typically in the form of, let's say, options. Companies give you employee stock options. Companies also give a lot of employees different types of securities such as RSUs, restricted stock units, right? So companies may give you ESOPs. Companies may give you RSUs. These are restricted stock units. This is nothing but employee stock options, or more commonly known as options, right? And then there are different things like RSAs, restricted stock awards. There is phantom stock, right? So companies can give you different type of securities as an employee. Now, whenever companies give securities to employees, there is a term called vest. Vest means you have the right to get the asset and then you can sell the asset if you want. So we say typically vesting. I have given it to you today, but you cannot sell until they are vested, right? And what is the condition for vesting? I am saying 1 year in the company. So after 1 year, you will be able to sell your securities. So although the securities are given to you today, you have a time-based vesting. Time-based vesting, the right is earned over time. Example, you complete 1 year with the company and then you can obviously sell your securities. But then there is also milestone-based vesting, which is performance-based. The right is earned when certain criteria are met. Example, you've achieved some revenue targets, you have achieved some objectives, goals, milestones. In that case, we will give you a right to sell these securities. And then there is also deferred compensation. Employees earn the right to compensation in the current period, but receive consideration in future period, right? So you've got the right in the current period, but the payments will be made in future periods, right? So only the consideration will be paid in future time period, but the right to get that money is today. Like benefits under the pension plans. As you work every year, you collect a bit of it as pension, but it will be paid only at retirement. That's a deferred compensation. Now, let's start with pension then. Pension plans can be of two types: defined contribution plan and defined benefit plan. And why are we reading here? Because these are nothing but liabilities. A pension is a liability for a business. Now, if a company is running a defined contribution plan, if the company says that we are going to follow a defined contribution plan, then the company contributes on the defined amount into the plan. Then the role of the company is to just deposit X amount into the plan. This defined amount is equal to pension expense, right? The defined amount that the company is going to contribute is called a pension expense. This expense is in the P&L, profit and loss statement, or the income statement. Balance sheet, you are decreasing the cash if paid out, else recorded as a liability. So let's say you work for me this year and there is $10,000 of pension that I owe you. So this $10,000, if I deposit in a pension account, right, my cash goes down. And if I do not deposit, I record $10,000 as pension related liability because I will have to give it over a period of time. So for the company, this pension expense is either an expense or a liability, either an expense or a liability. Perfect. Now, if this is a defined benefit plan, what is the difference between a contribution and a benefit plan? Company makes promises of future benefits to be paid to its employees, right? So again, it's like pension. Example, 80% of final salary to be paid each year until death. Assumptions need to be made regarding employees' expected salary at retirement. If I'm going to start a defined benefit plan, I need to make an assumption what would be the salary at retirement, because 80% of that salary is something that I will have to pay to an employee. And then number of years the employee will live after retirement, which is the mortality related assumption or the life expectancy assumption will something that I will have to work with. Life expectancy assumption. These are all called as actuarial assumptions. And then future cash flows are estimated and discounted to present value. So benefit plan is more complex. Benefit plan says first, try and estimate what would be the final salary you're going to make a payment to your employee, and then X percentage of that you will pay as pension. So estimate by how long will you have to pay that pension. And then for each year, forecast an amount, discount all these amounts to present value, right? And add them. As soon as you add them, what you get is your present value of future cash flows. Now, in benefit plans, besides this, there is also something additional that happens. In a benefit plan, the employer takes care of the plan, right? So when I say employer takes care of the plan, what I mean, in a benefit plan, the employer will manage the money. In a contribution plan, the employer does not manage. He just deposits it in a different organization. There would be, let's say, a pension fund manager who is going to then take care of that money. But in a benefit plan, the company takes the responsibility of managing the money. So what they do, if $10,000 is owned to you as pension, in contribution plan, this goes to a organization that manages it, right? Or let's say a fund management company. There will be a fund manager who's going to take care of this $10,000. But in a benefit plan, the company manages the fund, right? And if the company manages the fund's fair value or the fund fair value could be higher or lower. And this is what defines funded status. Funded status means fair value of these assets. What is the fair value of the asset, higher or lower? Minus the present value of obligations that you have to pay to your employees. If the value of the asset is greater than the obligations, we call it overfunded. We say that the fund is overfunded, which means there is more money. But if the fair value of asset is less than the obligation, we call it underfunded. Now, if it is underfunded, the employer will have to deposit more money into it, and that is negative for the employer. So fair value of plan assets, employer makes contribution into a trust fund and market value of assets held, right? So whatever is the fair value of these funds which the company is managing. Obligations present value of payments expected to be made post-retirement based on entitlements earned to date. A lot of assumptions like what is the final salary, what is the life expectancy, what is the inflation, retirement age, etc. Yeah, retirement age is critical. If retirement age extends, your salary assumption changes, your expectancy changes of life, a lot of things keep changing. So in a defined benefit plan, the employer takes care of managing the money. In a contribution plan, the employer does not manage the money. In benefit plan, the employer manages the money. Change in funded status, if there is any change. Income statement expense related to service cost, past service cost, and interest expense, all will be income statement related expenses. And what will be the changes in OCI, other comprehensive income? Any remeasurement related gains or losses, like extension of retirement age, may change your gains or losses. So all of that goes to OCI. So any pension related remeasurement or pension related gains and losses are part of other comprehensive income. If you remember OCI from our previous discussion, elements which do not impact income statement and get directly recorded on the balance sheet. On the balance sheet in OCI category, other comprehensive income, which means these things do not go to the P&L. They straight away hit your balance sheet and other comprehensive income on the on your financial statements. And OCI typically is nothing but profit after tax plus comprehensive income, or comprehensive income, sorry, is PAT plus other comprehensive income, OCI, sorry. So these things are going to impact income statement. Service cost means current service cost. What is the cost associated with the service that you are providing to the organization? Pension related cost. This is past service cost. If any assumption has changed and now I have to give you more or take or give you less because of the past service you have given me, that is ongoing here. And all the interest related expense or income, because this is a liability, right? This is a pension liability. Any interest expense or income is also income statement. But any remeasurement due to change in assumptions of life expectancy, retirement age, etc., is because of is recorded in OCI. Periodic change in balance sheet asset or liabilities for US GAAP. In US GAAP, apart from service cost and interest, there are a few more. Expected return on planned asset, amortization of past service cost, and amortization of actuarial gains and losses. So I think more than anything else, remember these names. In exam, they may simply ask you what is part of US GAAP or IFRS pension related calculations in the income statement. They may not ask you the math. The probability of asking the math is very low on this concept, because generally this is also asked in level 2. But they can ask you that, okay, expected return on plan asset is covered under US GAAP or IFRS from a pension perspective. In OCI, now two things: past service cost and actuarial gains and losses. Now, share-based compensation, as we said, you can be given stock grants or you can be given stock options. Both of them are type of share-based compensation. The benefit of share-based compensation makes sure that managers and shareholders are on the same, level, or maybe on the same page when we are talking about working in an organization, right? They work towards the larger benefit of the organization. And the way to motivate the managers and shareholders is offer the managers stock options, right? If you do good, company does well. If the company does well, the stock price does well, and even the shareholders make money and the managers also make money. The best part, it might not require spending money. The company may not have to spend money to offer these. I give you 100 ESOPs. I'm not giving you any cash, but I'm saying if you do well, your ESOPs will make a lot of money for you, right? So 100 ESOPs may convert into a lot of money. So then there's a motive for you to work towards the larger benefit of the organization. What could be the cost? It could lower profits and probably reduce earnings per share. You remember diluted EPS? We calculated diluted EPS, and in diluted EPS, we said PAT divided by shares plus shares given to options. So if you add more shares in the denominator, your EPS will reduce. So this can reduce earnings per share if you give them more ESOPs. Managers may not be able to control the stock price. The stock price is a function of several variables. It is not only a function of one variable or two variables. So the managers may not be able to actually get a true control on the stock price. And this could lead to being overly cautious or taking more risk. The managers may take a lot of risk because they know that if the share price goes up, they will also make a lot of money. In some cases, the managers may not take a risk at all. They don't want to destroy the value of the shares, so they may just be very, very low on taking risk. In either case, it is problematic from a company perspective. Too conservative, too aggressive can lead to outcomes which are not desirable from a business perspective. Shares given to employees are outright or with restrictions or contingent on performance. Three possible categories. You could have a completely outright share, which is they are evaluated based on shares fair value at the time of grant. These shares are distributed gradually over the service duration. If no constraints exist, the service duration is typically assumed to be the current time period, and their allocation reduces net income, resulting in added compensation expense equal to the fair value. So whatever is the fair value of these stock grants, that is basically recorded in present value, or rather in the financial statements. If you don't record them, then you are understating the expenses from a business perspective. Remember, they bolster common stock at par value and increase additional paid-in capital. Obviously, if you're going to issue options, and if these options convert to shares, the share capital is going to increase. So you can give outright stock grants to employees. Now, with restrictions mean you are putting some vesting conditions. So when we say stock grants with restrictions, we are saying a restricted stock grant involves a situation where employees are obliged to give back the shares to the company if certain conditions are not fulfilled. Right? Like I said, restricted stock units. Or RSUs. Or restricted stock awards. RSAs. Typically, the condition involves the employee remaining with the company for a specified period of time, often referred to as the service period or vesting period. So we are trying to keep it consistent with the vesting period or service period here. The value of these shares is determined at the time of the grant, right? So you will have to do a fair value. This is where a lot of companies hire valuation firms, right? And the valuation firms will typically provide the fair value of these loans. And these fair value of the grants have to be determined and recorded in the financial statements. The value is distributed gradually over the service period. So if I say the fair value of your grants is $20,000, then this $20,000 should be spread over the life of the grant. Let's say 3-year, 4-year, 5-year, 10-year life. Right. So if it's a 10-year grant, we are going to do $20,000 divided by 10, and $2,000 of the expense will be recorded in your profit and loss, called as stock-based compensation expense. Right? That is called as stock-based compensation expense. Right? So this will allocate, or this diminishes net income. It is a compensation expense. If you add a compensation expense, your net income generally is lower whenever more ESOPs are given. That is why you might have read sometimes companies say we are EBITDA positive, excluding compensation expense, right? Net of compensation expense, we are making profits. Simultaneously, it raises the common stock at par value and additional paid in capital, right? Obviously, shares will raise the additional paid in capital or common stock value. Stock options, fair value determined at grant date using a valuation model. Typically, we use Black-Scholes. Right? Black-Scholes model is used, or Black-Scholes model to option valuations is used to estimate the fair value of stock options. In the Black-Scholes model, volatility of the stock price is a crucial factor, right? So for volatility, we calculate the standard deviation of stock price. Compensation cost once again spreads over service period until first exercise. So during vesting, lower net income as there is more expense and raises additional paid in capital. On exercise, the increased APIC by the grant date fair value difference. Right. So on exercise price, raise common stock and increase the additional APIC by grant date fair value differences. So whether you do it with restrictions or you do it outright, there will be a stock-based compensation expense. That expense is going to be recorded on the financial statement and lower down the profitability. So how do you value options? You can use a Black-Scholes model. Level 2, level 3 effectively covers Black-Scholes. Even level 1 covers Black-Scholes slightly when you read derivatives. So you'll read Black-Scholes again there as well. Now, what are the guidelines for disclosures related to all of these liabilities, like leases? IFRS US GAAP disclosures designed to give information to assess amounts, timings, and uncertainty of cash flows. Right. So we are trying to provide all this information. What is the tenure of the lease? What is the amount of the lease? Who's the lessor? Are there any other contractual covenants? Everything is presented in the lease related disclosures. Type of lease, operating lease or finance lease. Pension, IFRS and US GAAP disclosures designed to explain characteristic and risk, identify amounts in financial statements, and describe the impact on amounts, timings, and uncertainty of cash flows. So in pension, you will have to present all the assumptions you have made in terms of retirement, time period, inflation. We have to provide all those estimates. Share-based component or compensation, disclosure designed to enable users to understand the nature and extent of share-based compensation arrangement. What is the fair value of the options? And that helps you understand what is happening with the option market. Questions? Anything on this? So expect mathematics on leases, expect theory questions on pension and share-based compensation. There is no math associated to pensions and share-based compensation. So expect theoretical questions on pensions and share-based compensation, but do expect mathematics on leases. May not be the full table, but part of the table is something that you can try and do. No questions? Okay, perfect. Surely good then. Let's take a logical break here, pause for 15-20 minutes, and then pick up income taxes as the fresh reading for the day. We have two readings to do, one leases and liabilities, and second income tax. So post the break, we'll take income tax all the way to the end of the session. Take a break, 15-20 minutes, and post break, I think let's resume on income taxes. Okay, perfect. I think let's get started then on income tax as a concept now. So when we are going to talk about income tax, we are largely focused on deferred taxes. I think CFA level 1 curriculum is more focused on deferred tax from an accounting perspective than anything else. So we are going to focus on what is deferred tax, deferred tax asset, deferred tax liabilities, and then do our assessment of deferred taxes. Now, when we say income taxes, income tax department, and again, yes, I think very important, we need to remember this, that income tax is something that varies based on geography, right? This is different for each country. And therefore, income tax rules keep changing based on the jurisdiction in which you operate. So each department has been given the authority to calculate and collect taxes from different legal entities on behalf of their government. And the income tax department therefore calculates tax as per its own rules, not as per the rules of financial reporting, which is accountancy. So there are typically two types of financial statements that you are going to find. One financial statement, which is prepared based on financial reporting guidelines, and second set of financial statements, which are prepared based on income tax guidelines. Since tax needs to be paid as per income tax, but accounting needs to be on accrual as per financial reporting, it results in a dichotomy, right? So now you are going to prepare two financial statements. You're going to prepare a financial statement for financial reporting, and there's another statement that is prepared for tax reporting. Because the two statements follow different rules, the amount of tax that gets calculated on both of them may vary. If tax is paid as per financial reporting, then the government is going to object that calculation. And if the tax is made as per income tax, then the shareholders will typically object, right? So how do you resolve this problem? How do you keep everyone happy and in line in terms of what is happening? Deferred tax possibly is the answer to the above problem, which helps in payment of tax as per government and provisioning of tax as per accrual. So deferred tax helps you reconcile the difference created because of these two different types of reporting. And therefore, you could have deferred tax asset or deferred tax liability that you will record on your balance sheet, and you will do accordingly adjustments to your tax expenses on the income statement. But always remember, each country will have a financial reporting and a tax reporting framework. And it need not be necessary that the framework between financial and tax reporting is the same. The framework between financial reporting and tax reporting could be different. Now, what are the differences between this accounting profit and taxable income? Accounting profit is what you're going to see in financial reporting, and taxable income is what you see in tax reporting largely, right? So financial reporting versus tax reporting. How are the terminologies different? Accounting profit as reported under income statement based on accounting standards. Then equivalent of accounting profit is taxable income, right? So equivalent of accounting profit is taxable income under tax reporting. Now, what is tax expense? Oh, this is taxable income, right? Sorry, yeah. Taxable income is here. Income calculated as per income tax rules. And this is income calculated as per financial reporting rules. Then tax expense, net charge in income statement for tax. This is under financial reporting. This is under financial reporting. This is under tax reporting. Income tax payable is under tax reporting. tax calculated as per the tax code and laws, it is equal to taxable income, which is statute and multiplied by statutory tax rate. So because this is for tax reporting, you will take the taxable income and multiply this by tax rate. And this is tax expense, which is based on accounting profit as such. Then the definition of effective tax rate or effective rate of tax, the expense divided by profit before tax, right? The income tax expense divided by profit before tax. So you can just back calculate this by income tax expense divided by profit before tax. Now, in financial reporting, the value of an asset or liability is called value of an asset or liability in financial reporting is called carrying value. But the value of an asset and liability in tax reporting is called tax base. So every time when we talk throughout this reading, tax base, you should know we are talking about tax reporting. Carrying value, we are talking about financial reporting. Taxable income, tax reporting. Accounting profit, financial reporting. Income tax payable, tax reporting. Tax expense, financial reporting, right? So the terminologies are different across the two. And this will effectively give rise to what are called as deferred tax asset, liabilities, and valuation allowance. What is a DTA? A deferred tax asset is created when your taxable income as per tax reporting is more than accounting profit as per financial reporting. And liability when taxable income as per tax reporting is less than accounting profit as per financial reporting. Valuation allowance, reserve created against DTA or reserve created against the deferred tax asset. What is valuation allowance? Valuation allowance is a contra account. In accounting terminology, this is a contra account, right? And we'll talk about why a valuation allowance is necessary or required, right? So we'll talk about why is it necessary or required. So these are the terminologies that you should be aware about while talking about deferred taxes. Different terminologies, different statements prepared using different guidelines. Now, why are there differences between income tax and financial reporting? There are two types of differences: temporary and permanent. The difference in tax base and carrying amount results in temporary difference, right? So if the value of an asset or liability between financial reporting and tax reporting are different, that may be as a result of temporary difference. The DTA and DTL is created as this difference will reverse in the future. Remember, this is temporary difference. Temporary difference means it is only in the near term. In future, this difference is going to reverse. Both IFRS and US GAAP require this to be reflected in the balance sheet, that what is the temporary difference. Now, simple example, take an example of a temporary difference, right? So let's put an example here for you. Very simple. Year 1, year 2, year 3. Carrying value of asset, right? Carrying value of asset, and let's say opening and closing carrying value and depreciation. Okay. So we are saying that the value of an asset was 100,000. Okay. 100,000 is the starting value. Okay. And we are saying that in financial reporting, Depreciation will be SLM, straight line method, 3 years. So which means this asset will be depreciated in 3 years. So financial reporting is going to do it like this. The asset of 1 lakh or 100,000 will be depreciated in 3 years and your asset will go to 0. Now, the same thing in tax reporting. The depreciation may be based on declining balance method. And the declining balance method may do it, let's say, in 4 years. Or let's say declining balance method simply. And the rate of depreciation, let's say, is 20%. So now this is not carrying value. Now this will be what is called as tax base, right? So we are going to simply call it, this is the tax base for me. So opening tax base of asset, closing tax base of asset. The starting value is the same, but now the asset gets depreciated by 20%. Right? So every year you are going to see 20%. And this will continue. This is going to continue in future also. But the idea is, in short term, you will have more depreciation here, lesser depreciation here. But in long term, this is a temporary difference. Why is this a temporary difference? Because in long term, all of us know the total depreciation will be 100,000. It's just the way the depreciation is getting calculated is different across the two reporting frameworks. Otherwise, the total will remain 100,000, right? So that is where we typically say this is a temporary difference, right? This is only going to, and this is declining. The only difference is the method of depreciation is different, which is why in short term, you're seeing depreciation differences, but in long term, the total depreciation will be 100,000 for both, and it is expected to reverse. So in near term, there is a difference, but in long run, no temporary difference will exist. Permanent difference, on the other hand, is one which is not expected to reverse in the future. A DTA, DTL is not created for permanent item. These items will have impact on the effective tax rate and will cause the firm's effective tax rate to differ from statutory tax rate. So no deferred tax asset or deferred tax liability here. There are certain income or expenses items which are not allowed by tax legislation. And there are certain tax credits for some expenditures which directly reduce taxes. Example, municipal bond interest. So in that case, there is no provision. Like simple example, financial reporting does not amortize goodwill. Tax reporting does amortize goodwill for 15 years. So this is permanent, right? Financial reporting doesn't even allow, while tax reporting allows it for 15 years. So the effective tax rate will change here in permanent difference. Income tax expense divided by accounting profit. How does the accounting work? So let's say there is a tax reporting revenue $10,000, allowable cost 8,000, taxable income 2,000, 30% tax 600, net income 1,400. Same for financial accounting. Revenue same, cost allowed 5,000, therefore tax 1,500, net profit 3,500. Now, what could be the source of differences? Accrual versus modified cash accounting. Right? The accounting terminologies, the accounting framework itself is different. Like I said, depreciation is a simple example of why the difference could be there. The income tax expense formula, therefore, is this. Tax payable 600 plus change in deferred tax. This delta means change in deferred tax. Now let's see what is the deferred tax here. Tax payable 600. Tax expense 1500. Right? So we said if your taxable income or your accounting profit, right? You can say my taxable income was 2000, accounting profit was 5000. Therefore, I'm paying tax payable 600, tax expense 1500. Now, whenever this happens, where your taxable income is less than pre-tax income, we say your tax payable is less than tax expense, and this basically is a deferred tax liability, DTL. This is a deferred tax liability. So now your liability is going to increase, and liability will be basically difference of the two, 900. Earlier you had zero liability, now you have 900 of liability. So you are going to say 900, the new deferred tax liability, minus zero, which is my old deferred tax liability. So if I add the two, I will get income tax expense of 1500. Income tax expense of 1500, tax payable of 600. The difference between the two, the link is change in deferred tax liability. That is how you link the two. So when we read the definition of income tax expense on the profit and loss statement, that income tax expense on the profit and loss statement is driven by this definition, tax payable plus change in deferred tax. The current tax assets and liabilities. Current tax liability means amount payable depending upon current taxable income, while current tax asset means expected refund from taxes already paid. So the liability and tax assets are different from DTA and DTL. They are current. Remember, they are current. DTA, DTL is a non-cash number. Always remember the DTA, DTL is a non-cash item. You don't pay cash for deferred tax asset and liability. It is just an accounting adjustment which you have to do. Reasons for DTA and DTL. Current tax and liability and asset are simple. Payment you have to make is your liability today, and refunds that you expect is your asset today. Now, recognition of income and expense in different time periods for accounting versus tax purpose. If you are recognizing income and expenses in different periods for accounting versus tax, that will result to a different profit and a different tax number. DTA and DTL will create it. Some income expenses might be recognized either for accounting or for tax purpose. As I said, amortization for goodwill only recognized in tax reporting, not recognized in financial reporting. And this is specifically for US. Again, the rules may change depending on another geography, right? If you're going to do a different geography, the rules are going to effectively be different. There could be difference in carrying amount and tax base, right? The value of the asset or the value of the liability could be different. And taxable income might be lower due to tax loss carry forward from previous year. So in some cases, you will have accumulated losses from the previous year. And if there are accumulated losses from the previous year, then again, in that case, your taxable income tax reporting may be lower. Financial reporting does not have anything called as tax loss carry forward adjustment. Tax losses can only be used for taxable income calculation, which can again be a reason why you will have a DTA or a DTL, a deferred tax asset or a deferred tax liability created on your financial statements. We talked about permanent difference and temporary difference, and we said permanent differences, differences which are not going to reverse, while temporary differences are differences which we are going to see a reversal of. Deferred tax is always equal to this difference into the tax rate. Whatever is your difference, timing difference because of temporary multiplied by tax rate. Only temporary differences can give you deferred tax. Permanent differences never create a DTA or a DTL. right? So no deferred tax asset or liability is created for permanent difference. Only temporary difference creates those DTA and DTL numbers for this. Definition wise, we are repeating what we studied right at the beginning. When tax as per income tax is more, it is deferred tax asset, right? So think about it. You wanted to pay $100 financial reporting, but tax reporting says pay $300. You will pay as per this. Whenever you pay more, it is an asset. So if the tax reporting says $300 and if financial reporting says $100, tax is paid as per this. The income tax authorities will collect tax as per tax reporting. So when they collect more than what you thought, you will call it an asset. And vice versa, liability. When something extra is paid than what is required, it is termed as an asset. Otherwise, it's a liability. Reasons for creating either a DTA or a DTL. Impairment is one reason, right? Some assets may get impaired for financial reporting, while it may not be impaired for tax reporting. Impairment means loss of value. If you remember, loss of utility. Any asset can see an impairment. It could be goodwill, it could be trade name, it could be inventory. Any asset, tangible or intangible, can be impaired. Provisions for bad debt. Again, financial reporting may allow it, tax reporting may not. An extra depreciation charged in financial reporting or warranty related expenses. The deferred tax asset is shown under current assets in US GAAP. For liabilities, if you're charging higher here, you're charging lower depreciation here. Shown under current liabilities under US GAAP. So there are multiple reasons why you will have a deferred tax asset or a liability. And what you see on your screens are only indicative reasons of a deferred tax asset or a liability. Always remember, the bottom line is if the accounting treatment does not behave similarly for both tax and financial reporting, there is a case of a deferred tax asset or a liability. Any accounting thing that you're going to apply, it should be similar. Taxable temporary differences. Those temporary differences which will eventually be taxable in the coming years. And this will lead to deferred tax liability in the balance sheet. The deferred tax is not allowed under US GAAP for amortizable goodwill, while it is allowed under IFRS for goodwill from business combination. So within US GAAP and IFRS also there are differences which lead to a deferred tax asset or a deferred tax liability. In exam, you could be asked to identify if there is an asset or a liability, right? So if you are running an asset or if you're running a liability, right? So you should be able to identify whether there will be an asset or a liability. What are deductible temporary differences? Those temporary differences which will allow reduction in taxable income going forward. So this will typically lead to DTA in the balance sheet if there is a reasonable chance of future profits. And this word is important. If you do not have a chance of making future profits, then you will have to think, do you have to keep a DTA on the balance sheet? You are saying I have a deferred tax asset. You will only be able to use the asset if there are losses. Okay. So if you think you will never have profits in future, then we will have to remove the deferred tax asset from the balance sheet because you will not be able to use it. And how are we going to remove? We are going to remove it using valuation allowance. It will come shortly to that. But if you think there will be no future profits, then DTA should be removed. And to remove the DTA, we use valuation allowance. So if you have a deferred tax asset of $100 million, but you don't believe that company is ever going to make a profit, you will simply call a negative line here and call it valuation allowance You will write valuation allowance as $100 million and move your deferred tax asset to 0. You will just put a valuation allowance equal to the DTA and call your valuation DTA as 0 value. And this $100 million goes to the income statement as a loss. Because if you're not able to recover your assets, you are effectively losing. Right? There's a loss for you on your income statement. Valuation allowance, we will say it's a loss of $100 million on the income statement. In future, if you make profits, you can reverse the entire calculation. Then you can reduce the allowance and you can bring the DTA back on your balance sheet. But if not, you should remove the DTA from the balance sheet. So always remember, valuation allowance is a contra account. I think it should be somewhere. I'm just trying to find where is valuation allowance. I don't see it anywhere here. Fair enough. I think not a problem. The simple answer is, I think this. If you have a deferred tax asset, as I said, of $100 million, if no profits in future, then DTA minus valuation allowance and 0. This is 100. This is 100. Your DTA is 0 after putting valuation allowance. And that $100 million goes in the income statement as an expense. Right? This is going to reduce your profit after tax by $100 million. You've lost that $100 million because you're not able to recover it. But in future, if you have profits, okay, in future, if you have profits, reverse the entire process. You will reduce valuation allowance from 100 to 0. DTA will come back to 100. And then if you have profits, you can use the deferred tax allowance or deferred tax asset to reverse the numbers. Right. So DTA for the deferred tax asset, this is a contra account. The contra account, if you remember, is a negative number that reduces the value of an asset or liability over a period of time on the balance sheet. Clear? Now let's work with an example of a deferred tax liability. A firm acquires an asset for $21,000 with 3-year useful life and no salvage value. The asset will generate $16,000 of annual revenue for 3 years. Tax rate 30%. For depreciation method, tax purposes is using double declining balance method and accounting is using straight line method. So let's put all of this on an Excel to quickly solve and work the numbers for us. Very similar exercise, I think, but it's okay. Let's just put the numbers here. Perfect. Let's try the numbers. So now, for the value of the asset given to us is $21,000. 3-year useful life, no salvage value, right? So very similar. 3-year useful life, straight line value, no salvage value. No salvage value means you don't have to worry about salvage value while doing your depreciation calculations. Otherwise, a straight line method of depreciation is cost of the asset minus salvage value divided by life. Because we don't have salvage value, we are just going to put it to 0. Perfect. So $7,000 of depreciation every year. Now, this is accounting. Financial reporting is using straight line method as the question says. What is tax doing? Tax is using double declining balance method. What is double declining balance method? It is nothing but declining balance 2 times. Right. So if you're going to do tax reporting, that will be 2 times. So let's first finish financial reporting. So financial reporting says revenue $16,000. Right, revenue is $16,000. Then from revenue, we will subtract depreciation for $7,000 every year. Right, so from revenue, we are going to subtract depreciation. What we will get is pre-tax profit or pre-tax income. This minus this. $9,000 of pre-tax income, right? For this question, $9,000 of pre-tax income. To this, we are going to apply a tax at 30%. Right? So we are going to say 30% tax. And this is basically your net income. Right? This is your net profit. All that we have done here, everything that we have done is under financial reporting. Remember, this is all under financial reporting. Perfect. So under financial reporting, we have this framework, right? Straight line method of depreciation and financial reporting is done. Now let's try the same thing on tax reporting. On tax reporting, we have been told that on tax reporting, the depreciation is double declining balance method, right? Which means you will have to change your depreciation for tax purposes, right? So when we say double declining balance method, we are going to calculate our depreciation for double declining balance method. Now for double declining, obviously it is value of the asset multiplied by or divided by obviously life and multiplied by 2, right? Whatever is your remaining value. So the double declining balance method depreciation, just calculated here, double declining balance 2 by 3 because our life is 3. So 2 multiplied by cost minus accumulated depreciation divide, right? Divided by life. So step 1, what is your cost? Your cost of the asset was 21,000, right? So the cost of the asset remains, sorry, $21,000 by 3 multiplied by 2. First year, 14,000 depreciation. There is no accumulated depreciation. Remember, there is no accumulated depreciation. Till now, your asset has not been depreciated at all. Zero depreciation. So in first year, you are taking cost of 21,000 minus accumulated depreciation of 0 divided by life of 3 years multiplied by 2, double declining. Next year you are saying, I have already depreciated it by 14,000. You get the formula? I've already depreciated my asset by 14,000. So cost minus 14,000. Whatever is left over divided by 3 into 2. Your depreciation will be 4,667. What should be the formula next year? What should be the formula next year? For double declining based on this concept. Accumulated depreciation next year, cost minus the depreciation total. You have depreciated it by, we have already depreciated it by 21,000 minus the depreciation. Your accumulated depreciation now is 18,000. So the leftover value is 1,556. So your depreciation changes now. Now your depreciation is different. This is your depreciation now. Cost minus accumulated depreciation. And now doing this, your profitability is also different. If you notice, now your depreciation changes. Because of depreciation, now it is not called pre-tax income, obviously. This is something that we are going to call taxable income. And taxable income will have a different tax number. Perfect. Questions? Okay. So what we have done, we have created a financial reporting statement and we have created a double declining balance or a tax reporting statement, where the double declining balance is if you're going to depreciate it by 33% in 1 year, depreciated by a double rate every year, right? So 66% rate every year. Let's go back with this, right? And compute the tax implications is what we are trying to work with. What are the tax implications? From a tax perspective now, every year, since we are now going to depreciate it by higher number, our net profit is different here also and here also. So we need to see what is the DTA or a DTL that we create. Now in first year, your pre-tax income is 9,000. Sorry, your tax is 2,700, while the income tax is 600. You have paid only 600. You were supposed to pay 2,700 as per financial reporting. You have paid 600. So in first year, you will have a liability of 2,100 because you paid less. So in first year, it's a liability. Second year, your tax is 3,400. Your tax is 2,700. DTA, you have paid more. And third year also a DTA. So first year, you have created a deferred tax liability. In second year, you have created deferred tax asset. And in third year also, you have created a deferred tax asset. So this is fine. We have some numbers here. Taxes, DTA and DTL. And now, what is the amount of deferred tax asset and deferred tax liability that we are looking at here? What is the amount of a DTA or a DTL that we are looking at? The amount of deferred tax asset or deferred tax liability is basically the difference between the number that is causing this or the taxes straight away, your choice. You can create it straight away based on the numbers, right? So for example, the deferred tax liability is this minus this, and assets are 700 and 1633 negative, right? So I'm representing liabilities as positive and I'm representing assets as negative here. So you can subtract the two tax numbers. If you don't want to subtract the two tax numbers, you can also do it using depreciation, right? It's depreciation per financial reporting, depreciation per tax reporting. So for financial reporting, the depreciation is 7,000. For tax reporting, the depreciation is 14,000. You can subtract the two, which is called as timing difference. Timing difference, this minus this, and multiply the timing difference by tax rate. Multiply the timing differences by tax rate. What you will get is exactly the same numbers. So it is your choice. You can straight away do it using the tax numbers, or if you want, you can do it using the depreciation numbers also, right? So either ways, you should be able to get whether there's an asset or a liability. Did you follow the math? Before we do the tax base and carrying value calculations also, tax base and carrying value.
Yes, sir.
Okay. So let's also parallelly calculate what will be the tax base and the carrying value. So what you see here, this is nothing but carrying value, right? You are saying this is the carrying value of my asset. The carrying value goes from 14,000 to 7,000, from 7,000 to 0 over a period of time. That is my carrying value, 14,000, 7,000 and 0. These three numbers are nothing but the carrying value for me because this is financial reporting. Tax reporting, I can calculate the tax base. Oh, this is the tax base is already here. So we can calculate the tax base. Tax base means I will start at 21,000. And after 1 year of depreciation, my value is 7,000. Next year, the value is 2333. Next year, the value is 778. So this is nothing but my tax base. So now you have two different numbers. You have tax base also, and you have carrying value also. This is the carrying value of the asset. You can also subtract these two and multiply by tax rate to get DTA or DTL numbers. You can simply subtract and multiply by tax rate to get a deferred tax asset or a deferred tax liability number. So tax base, carrying value, your carrying value is 14,000, 7,000 and 0. Your tax base is 7,000 and this. The difference is this. Multiply that by tax rate. What you will get is the value, but for the change, we need the change, right? For the change, we will subtract them. So this is your value. And now, because you need to calculate the change in DTA DTL, right? The change in DTA DTL, this is nothing but DTL. So the change in DTL is 2,100 minus previous year, right? Previous year, the number was 0, right? So the change is 2,100 minus previous year. Next year, minus 700 and next year, minus 163. So what you get here is a change in DTA DTL that can be done using carrying value and tax base also. So you can use depreciation to calculate this. You can use straight away the change, the subtraction of the two numbers, or you can calculate it using tax base also and carrying value also. It's up to you. How do you want to calculate? The numbers are more or less the same. Perfect. If you got this, let's move forward and try this. Okay, give it a try to this. Try solving this. Let's see what your deferred tax asset liability numbers are. Can you identify DTA, DTL correctly? Make a tax reporting, make a financial reporting. In tax reporting, you will get in financial reporting, you are going to get warranty expense in your profit and loss, right? So in profit and loss, include an expense called warranty expense in financial reporting, right? So this will be part of your income statement under financial reporting. However, under tax, because tax works on cash, this will be only in the third year in tax reporting. So in tax reporting, there will be no financial warranty or warranty related expenses. Give it a try. Let's prepare two tables and let's try and identify, are there any deferred tax asset or liabilities. Make a 3-year profit and loss statement. To simply follow these 5 lines in terms of your revenue expense mechanisms. Pre-tax income, taxable income, tax payable, net profit. Get the terminology right.
So,
Yes.
so in tax reporting, the
Mhm.
tax won't change for the first 2 years, but for the third year, the tax would change.
Yes. In tax reporting, what we are going to do, we are going to showcase revenues of $8,000 for all 3 years. In the expense category, we will have only one expense in the last year, which is $3,000. So your taxable income will be 5,000, 5,000, 8,000, 8,000, and 5,000. Sorry. And therefore, you will have only tax change in the last year. This year will be 8 into 3, 2.4 thousand, 2.4 thousand, and 1.5 thousand as your tax payable. Right? This should be your tax profit and loss. 8 minus 2.4, 5.6, 5.6, 3.5. That is how your tax reporting profit and loss should look like. Because the repairs related expense, if the warranty claims was not made, is $3,000 actual expense, and tax works on actuals then accruals.
Yes, so it's DTA, DTA, and DTL.
In this case, it will be 8K, 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 all 3 years of revenue. Then you will have warranty expense of 1K, 1,000, 1,000 every year. You will have 7,000 every year as your pre-tax income, and 2.1 thousand, 30% of that as your expense, tax expense. So your net profit will be 4.9 thousand in all of these cases. So now, once we have the numbers, we need to identify whether there is a deferred tax asset or a deferred tax liability. Simple way to look at this is financial reporting says paid 2,100 as tax, while tax reporting says paid 2,400. You pay more. You pay more. First year, you have a deferred tax asset. Amount 300. Second year, again, you want to pay 2.1. The tax says pay 2.4. You have a DTA again of 600. Third year, 2.1, 1.5. You have a DTL. You don't have an asset in the third year. You have a liability in the third year. Sorry. So 24, 24, 1,500 for tax. 21, 21, 21 for financial reporting, and only assets in the first 2 years. You don't have any asset in the last year. In the last year, you rather have a liability. So the treatment is assets and the liability in the last year. And we are showing change in deferred tax assets. It was 300, it was then 600. So the change is 300 minus 0, 300, 600 minus 300, 300. Next year, there is no asset. So 0 minus 600, 600. The change in deferred tax asset is 300, 300, and 600. Or minus 600 actually. Liability base. How does the liability base work here? So you had $1,000 liability, deductible in future period is again $1,000. Your tax base is 0. Next year, $2,000, again deductible $2,000, 0. So carrying a value minus any amount that will be deductible for tax when liability is settled. So in this case, we are settling it for $3,000 by doing $1,000, $2,000 deductions. Tax approach, you take the carrying value tax base. Carrying value is 1,000, 2,000, tax base is 0, 0. You will still get the same number, right? So like we did for asset, you're doing it for liability. In the previous example, we looked at it for asset. Therefore, we are doing depreciation. In this case, we are saying there is a liability. Warranty is a liability. So for liability also, there is a tax base or a carrying value. And the difference of the two will effectively give you the value or the change in DTA numbers, right? So if you want, you can do a change in DTA using expenses. Or if you want, you can do a change in DTA, like we said previously, using the carrying value and tax base. Right? Like in our Excel example also, we did very similar. We did it using expenses, and then we did it using carrying value and tax base. In either case, we said you can get to the right number. So tax basis, examples and solutions. If dividend receivable from subsidiary carrying value is €1 million and tax base is euro, timing difference is 0, no DTA, no DTL. Development cost, carrying value higher than tax base, timing difference 250, you have a DTL. Research cost other way around, you have a DTA. So similarly, if you have been given your asset numbers, liability numbers, you can subtract the timing differences, and based on the timing difference, you can calculate a DTA or a DTL. Think about it. The easiest way to identify a DTA, DTL is how will this behave on the income statement? Will there be depreciation? Will there be amortization? Do I need to look at anything from the income statement perspective? Similarly, donations, there's no value, nothing applicable. Interest received in advance, 300, tax base 0, asset. So whenever you have a positive timing difference, that's an asset. Easy way to remember. Whenever there's a negative timing difference, it's a liability. Now, what is the impact of tax rate changes? It's a directly proportional impact. If the tax rate decreases, deferred tax liability also decreases, income tax expense also decreases. If tax rate increases, liability also increases, expense also increases. But assets, if tax rate decreases, assets decrease, and income tax expense increases. The reason being, income tax expense is a function of this two, change in DTL and change in DTL. So if tax rate is decreasing, this is decreasing. This is also decreasing. But your tax expense is going to increase because minus and minus will make it plus. So your tax expense is actually going to go higher. These are very easy to remember. Deferred tax asset and liability increase and decrease with tax rate. But the only thing is income tax expense behave opposite. If assets decrease, they increase. And if assets increase, they decrease. Accordingly, you can change the other sign. The equation is this. They are dependent on this equation. Income tax expense is tax payable plus change in deferred tax liability minus change in deferred tax asset. And you know what? This plus and minus is very similar to what we have read previously. Sorry. If you remember cash flow, in cash flow, we said any increase in liability is increase in cash, and any increase in asset is decrease in cash, right? So that is where we typically say any increase in liability is increase in cash, and any increase in asset or decrease in asset is a increase in asset is decrease in cash. So if your asset is increasing, your income tax expense is decreasing, follows a very similar logic. If your asset is decreasing, this is going the other way around. Liabilities follow the same direction. Same direction. Increase in liability, increase in cash. Similarly, increase in liability, increase in expense. And accordingly, you can take the other position if you forget the equation. But you could be tested on the equation, therefore be aware at least about the equation. Now, realizability, as we said, a valuation allowance reduces a deferred tax asset. This is what we were talking about. Based on the likelihood that the asset will not be realized, US GAAP says full DTA shown offset by valuation allowance. As we were saying, full DTA shown $100 million offset by valuation allowance $100 million, zero. Okay. And in IFRS, DTA shown is adjusted for probability that the asset will not be realized. In either case, if it will not be realized in futures, they can be reversed if required. Right? There is nothing for DTL. There is only for assets. Accounting says be conservative. If your liabilities are not going to be recognized, you can move your liability to equity. But if assets are not recognized, remove the asset from the balance sheet and recognize it as a loss. So valuation allowance, please remember, is a contra account. Valuation allowance is a contra account, and a contra account only to deferred tax assets. How does the analyst treat? Analysts should treat deferred tax liabilities that are expected to reverse as liabilities. If DTLs are expected to reverse, treat them as liability. Otherwise, as I said, if DTLs are not expected to reverse, then treat them as equity. Move them to equity. That is equity classified as equity. If the amount and timing of payment relating to DTL are uncertain, then treat them as neither liability nor equity. If we are not sure what is the amount, we'll not recognize them at all, because then there is a timing issue that we are working with. So very important, this line from an exam perspective and the line that deferred tax assets can be treated using valuation allowance. And valuation allowance is nothing but a contra account. In general, a lot of times these questions come. Can be reversed if in future the company makes profits. Now, what is a statutory tax rate? Statutory tax rate is the tax rate which the company pays in a domicile, right? In the country where we operate out of. So for example, in US, the statutory tax rate can be 21% federal plus state tax multiplied by 1 minus 21%. So you can say that the state tax is 8.84% for California multiplied by 1 minus 21%. So whatever this turns out to be is your statutory tax rate for a company headquartered or operating out of California. But effective tax rate has tax expense by pre-tax income. So effective tax rate can be lower because your tax expenses may be lower, possibly because of loss carry forwards. You have loss carry forward, or there is also a reason you have some DTA, DTL, which is reducing this income tax expense. So effective tax rate is what you effectively pay. Effective tax rate is a financial reporting concept, while cash tax rate is a tax reporting concept. Cash paid for taxes divided by pre-tax income. Remember, effective is not equal to statutory because of temporary differences, timing differences, overseas operations, tax rates, and US GAAP, IFRS will require a reconciliation. You will have to present a reconciliation that why are your tax rates not equal and what is leading to the difference in tax rates, right? Between statutory and effective, you will have to present a disclosure in your financial statements. Clear? Questions? Take an example. On January 1, Neutrino acquires company domiciled in South Korea. Statutory tax rate in South Korea is 25%. The company earns $500 in profits. Assuming US and Ireland operations each increase pre-tax profit by 25%, what is the effective tax rate for the consolidated entity? So US, $1,250, 21% tax rate, 262. Ireland, 1,250. Right? We are assuming the pre-tax profits were $1,000 and they increased by 25% to $1,250. Korea, $500, tax rate 25%, which means your total tax is 537 on a total income of 3,000. So your effective tax rate is 17.9%. Profits divided by, or taxes divided by pre-tax income. Obviously, question should give you tax rates also, right? In this case, I think they're provided here, but the question should offer you on tax rates. Perfect. So I think that is all that we had for today. Two readings, long-term liabilities and income tax.